I'll bring it up again, Matt, but I love Jason Zweig's piece in the Journal over the weekend saying a lot of investors have fogey. They have fear of getting in, and I totally understand that. They feel like it's always all-time highs because it basically always is.
Yeah, we've got earnings growth at least, though, and earnings growth is going to be the most important driver of returns. S&P 500 is getting back up to that high multiple we reached back in November. It's only 5% higher now in terms of the multiple expansion you're likely to get, but the earnings growth in tech, healthcare, industrials, communication services is looking like double-digit growth over the course of 2025. We're leaning into U.S. high-quality companies with earnings growth. Right now, there's been this Sell of America trade over in the courts of May. We would lean into that, buy America here. And actually, mid-cap and small-cap stocks are the only thing cheap on the planet anymore in terms of equities. That's where we're looking to allocate capital, is more in the mid-cap space and those sectors in particular.
Okay, fair enough. But is it that the market is strong where the earnings are strong? And is that not so much the case with small and mid?
Yeah, so you got to use what we're looking for is a PEG ratio. So it's like golf, the lower the better, but it's the earnings growth that you're getting relative to the multiple you're paying. So PE divided by the G, or the growth rate. And so that's a way to be disciplined and not to overpay for the growth. I do hear you. There are some pockets that are expensive, but some of the expensive pockets actually don't have earnings growth. So you just got to be thoughtful there. And then in mid-cap, you're right. The earnings growth isn't as robust, but you are getting a much cheaper multiple. And so if you can get any turnaround story there, we continue to look at industrials. I know we've talked about it on your show multiple times. Industrials, one of the best performing sectors this year. It's one of these build it and they will come type years. This is a whole field of dreams type quote, and news like today where you've got utility companies, infrastructure companies building out all these type of data centers. That's earnings growth too. Yeah, so we do see pockets of earnings growth, even on reasonable valuations. That's where we're gravitating towards.
Not to put you on the spot, but where do you see companies that have kind of high valuations or have run up but don't have the earnings, you think, to back it up?
So real estate is one, consumer discretionary, consumer staples. A lot of it is consumer related, frankly. But if you're thinking about CapEx and industrials, those have better earnings results. Utilities actually have good earnings growth this quarter. We're some of the best, 14% earnings growth. Healthcare has gotten crushed, still has great earnings growth. So we're just trying to find those pockets of opportunity. There's a lot of political back and forth, trade headlines, but it's opening up these pockets of opportunity where there's some value in earnings growth, and that's where we're seeing some good spots.
Stick with the lower peg. That's what I'm taking away from this. Matt, thanks very much. Appreciate it today.